In the last 48 hours, a single number on Wall Street screamed crisis, while the headline index barely flinched, 4% on February 3rd, 2026. That's the contradiction. The surface move looked like an ordinary pullback. The pricing of protection looked like the market was bracing for something that should not be happening in a calm, liquid system. And when you see that kind of mismatch, it usually means the story is not in the headlines, it's in the tape. Not the tape most people watch either, not the cash market that prints a clean percentage change at the end of the day. The tape that matters here is the one made of hedges, margin, and forced repositioning. The tape that institutions read in real time long before the narrative catches up. Because volatility is the polite word. It's what you call it when you can't say out loud that the plumbing is straining. It's what you call it when the market is being moved by mechanics instead of opinions. And if the mechanics are moving, someone is paying for it. Someone is being forced to act. Here's where it gets interesting. The market can hide stress for a long time, until the stress concentrates into one place that can't absorb it. When that happens, it's not months, not weeks. It can happen in 2 sessions. It can happen in 1 afternoon. And if you're watching the wrong scoreboard, it looks like nothing, until it doesn't. Welcome to Channel Name, where we decode what matters before it becomes a headline. If you're the kind of person who likes understanding why the market moved instead of repeating what it did, you're in the right place. If this is useful, stay close, the way you'd keep listening to that one calm voice who explains the room when everyone else is shouting. And tell me where you're watching from, because I want to know how far this tape reaches beyond New York. Now, let's reconstruct what actually happened, and why the label volatility is doing a lot of work. On February 3rd, 2026, risk assets sold off. Nothing apocalyptic on the surface. 8%. But protection repriced hard. VIX above 20 is not a footnote. It's a re-rating of uncertainty. It's traders paying up for convexity, not because they feel emotional, but because their models demand it. And that's the first clue. Models don't get scared. They get triggered. At the same time, you could look elsewhere and see the world refusing to tell one coherent story. 8%, while the UK's FTSE 100 was closing at a record near 10,341. Metals collapsing while an equity benchmark prints a record is not impossible. But it is unusual enough to ask a simple question. What is being sold and why? Is it a view on growth? Is it a view on inflation? Or is it a view on leverage? Because when leverage is the driver, it doesn't care what you believe. It sells what it can, not what it should. It sells what has a bid, not what deserves to go down. That leads to the central mystery. Why did the cost of protection surge when the index move looked contained? And why did certain markets behave like a liquidation while others behaved like a celebration? To answer that, you have to zoom out and then zoom in. Zoom out to the historical pattern. Then zoom in to the institutional mechanics. Start with the pattern. This is not the first time the market has looked calm in price while screaming in structure. In 1987, portfolio insurance strategies were marketed as risk management. The idea was simple. As the market fell, you would sell futures to reduce exposure. It sounded prudent. In reality, it created a feedback loop. Selling caused more selling. Liquidity vanished when everyone needed it at once. Result? A one-day collapse that still defines modern market fear. In 1998, long-term capital management was not a story about one trade. It was a story about positions sized on the assumption that spreads would behave. When Russia defaulted, correlations snapped. Models that relied on normal distributions were suddenly operating in a world of fat tails. The Federal Reserve facilitated a private sector rescue because the problem wasn't one hedge fund. The problem was the network of exposures around it. In 2010, the flash crash showed that a market can drop violently and recover quickly, leaving behind one lesson. Liquidity is a behavior, not a promise. When the order book thins, prices can travel farther than logic would allow. In 2018, the so-called Volmageddon event exposed how short volatility products can implode when volatility rises quickly. Strategies that sold volatility for carry looked stable, until volatility rose. Then the hedging and rebalancing mechanics became the story, and the underlying index moved more because of the products tied to it than because of fundamentals. In March 2020, the shock was real, but the market's most telling moment came when U.S. Treasuries, the so-called risk-free benchmark, showed signs of dysfunction. That's what happens when everyone wants the same hedge at the same time and balance sheets can't expand quickly enough. Different years, different catalysts, same playbook. The market appears fine, then the hedging structure starts to strain, then the move accelerates, not because a new fact appeared, but because positioning made the system fragile. 8%, it's reasonable to suspect the structure is becoming fragile again. Not guaranteed, not destiny, but historically, it's a signal worth respecting. Now, let's talk about the players, because markets don't move in a vacuum. They move through institutions, rules, and incentives. The first institution to name is the options complex itself. CBO, the dominant US options venue, has overseen a market that has grown into a machine, 6 billion contracts. That is not a sideshow. That is a parallel stock market layered on top of the stock market. And inside that options market is a product that changed the rhythm of trading, 0 days to expiration options, or 0 DTE. In the S&P 500 index options ecosystem, estimates have put 0 DTE at roughly 59 to 60% of SPX options volume. Think about what that means. More than half the activity in that benchmark can be tied to contracts that die today. A contract that dies today forces hedging today. It forces dealers to adjust exposure intraday, sometimes minute by minute. It compresses risk into short windows. It turns the market into a machine that can overreact to small impulses, because hedging is not discretionary. It is mechanical. Dealers who sell options hedge their risk by buying or selling the underlying exposure. If they are short calls and the market rises, they may need to buy more as it rises. If they are short puts and the market falls, they may need to sell more as it falls. This is the famous feedback loop of gamma. It can stabilize markets when positioning is supportive. It can destabilize markets when positioning flips. And here's the part no one is discussing enough. In a world dominated by short-dated options, the hedging flows can matter as much as the investor's opinions. Sometimes more, because opinions can wait. Delta hedging cannot. Now add the second institution, the futures and clearing ecosystem. The CME is not a headline brand to most people, but it is the engine room for many markets. It sets contract specifications, it manages clearing, and it changes margin. Margin is not a suggestion. It is the price of leverage. If margin goes up, positions have to shrink unless someone posts more collateral. That's why margin changes can move markets even when the news cycle is quiet. 9% for silver. Whether you trade those instruments or not, understand the mechanism. When margin requirements tighten, someone, somewhere, has to find cash. If they can't, they reduce risk quickly. This is how volatility becomes a cascade. You don't need a conspiracy. You need a chain of obligations. Now think about the timing. February 6th, metals are slammed. February 3rd, equities wobble and implied volatility jumps. That sequencing is familiar, not because the assets are identical, but because the pressure often starts where leverage is concentrated and collateral is sensitive, then migrates. Collateral is the hidden common denominator. Large institutions hold portfolios. They finance positions. They post margin. They manage risk limits. When one area of the portfolio experiences a volatility spike, the risk system doesn't politely isolate it. It recalculates. It demands action across the book. One more tell is how quickly safe collateral gets hoarded. In stress windows, desks prefer cash and short bills, even if yields barely change. Repo haircuts can tighten. Prime brokers ask for more cushion. That doesn't show up on a chart until it does, because it happens in calls and intraday limits and quiet emails that say, reduce exposure by end of day. The tape feels it immediately. No debate, no delay. That brings us to the dislocation. Two markets, two stories. Story one is the cash equity index, a manageable decline, less than 1% in the S&P 500 on February 3rd. Many viewers see that and think, this is normal. Markets go up and down. Story two is the protection market, VIX above 20, telling you that near-term uncertainty is being priced aggressively. That is a different story. It says the market is paying for insurance as if the distribution of outcomes just widened. And then there's a third story hiding in plain sight, the commodities tape. 8% on February 2nd, while an equity benchmark like the FTSE 100 prints a record around 10,341. That juxtaposition suggests rotation is not the right explanation. It suggests forced flows, because if it were a clean macro thesis, you'd expect consistency. You'd expect bonds and gold to behave one way, equities another. You'd expect a coherent narrative. Instead, you get conflicting signals, and conflicting signals often mean the market is not trading a thesis. It is unwinding a position. Let me show you what this actually means by walking through a simple human analogy. Imagine a crowded theater with multiple exits. Everyone is comfortable while the lights are on. Then someone smells smoke. Not a fire, just smoke. A few people stand up and head toward the door. The room barely changes, but the security team sees movement. They open a side gate. That changes the flow. Now a few more people move, and suddenly the crowd dynamics take over. People are not running because they saw flames. They are moving because other people are moving, and because the pathways changed. Markets behave like that. The first move is often a whisper. The second move is the system reacting to the whisper. The third move is the crowd reacting to the system. In market terms, the whisper could be a small drop in a major index. The system reaction could be 0 DTE hedging and dealer gamma flipping. The crowd reaction could be a margin call or a risk parity rebalance that forces selling across assets. Now, let's anchor this with evidence, specific numbers, concrete mechanics. Evidence point one, the volatility jump itself, 8%. That is a higher volatility response than the index move would normally justify if the market believed the move was contained. Evidence point 2, the scale of the options machine. 6 billion options contracts traded in 2025. That volume matters because it implies a huge amount of intraday hedging and exposure turnover. When a large share of activity is short-dated, the market's sensitivity to small moves increases. Evidence point 3, the concentration of same-day options. Roughly 59 to 60% of SPX options volume tied to 0 DTE. That tells you the dominant participants are not thinking in quarters. They are thinking in hours. That changes the tape. Evidence point 4, margin as a trigger in adjacent markets. 9% for silver during late January 2026 volatility responses. Margin changes act like gravity. They pull leverage down. Evidence point 5, cross-market stress signatures. 8% on February 2nd, 2026, while the FTSE 100 printed a record close near 10,341. That is a stress signature because it suggests liquidation pressure in one area while another area remains buoyant, which can happen when capital is being raised rather than a macro view being expressed. Now we connect the dots. What do these points suggest? It is in a regime where microstructure can dominate, where protection can get expensive quickly, where dealers hedging can amplify small moves, where margin and collateral can force selling in unexpected places. This is the part that changes how you interpret the next headline. When commentators say volatility returned, they often mean price moved more than yesterday. But the tape can tell a different story. Volatility is being manufactured by positioning, and the market is paying for insurance not because it knows a fact, but because it knows the system is set up to lurch if a catalyst hits. So how is it executed? Mechanically. Not through secret meetings. Through ordinary rules. Step 1 is positioning. Funds sell or buy options. Some sell volatility to collect premium. Some buy short-dated protection because it's cheap until it isn't. Some use 0 DTE to express views cheaply and frequently. Step 2 is dealer hedging. Dealers dynamically hedge the net exposure they carry. When markets are calm, this can dampen moves. When markets approach key strikes and positioning is large, the hedging can become pro-cyclical. That is when the tape accelerates. Step 3 is margin and risk controls. Clearinghouses adjust requirements. Prime brokers reassess risk. Internal risk systems tighten limits. These are rational responses, but they force flows. Step 4 is forced selling or forced buying. The forced part is what matters. Forced flows are insensitive to price. They are indifferent to valuation. They push until the constraint is relieved. Step 5 is narrative. After the fact, the world looks for a story. It finds one. But the tape already told you it was a mechanical unwind. Now here's the forward-looking implication, stated carefully, without pretending anyone can predict the future. Historically, when the market enters a regime dominated by short-dated options and tight collateral, outcomes tend to cluster into a few scenarios. In a conservative scenario, the market digests the positioning. Volatility remains elevated but contained. The VIX can stay above 20 for stretches as participants continue to pay for protection. Price action becomes choppy. Leadership rotates. The system vents pressure through time rather than through a crash. In a moderate scenario, a catalyst arrives during a fragile positioning window. That catalyst can be ordinary, like a data release, an earnings cluster, or a policy comment. If it hits when dealer gamma is negative and 0 DTE positioning is heavy, the hedging can amplify the move. The result is a fast air pocket style decline followed by a rebound, leaving behind higher realized volatility. In an aggressive scenario, the stress migrates into funding and collateral more broadly. That is when multiple assets sell together, not because their fundamentals align, but because balance sheets are constrained. Historically, those moments are marked by widening spreads, reduced liquidity, and abrupt repricing of risk. Notice what's missing: a guaranteed outcome. Markets are probabilistic, but the pattern is consistent enough to watch for specific indicators. So what should you watch? Not as a prescription, but as a lens. There's another layer most people miss: the term structure of fear. That's urgency. It says the market is worried about a window, not a decade. Institutions express that urgency through short-dated puts, put spreads, and dynamic hedges because the goal is to survive a specific stretch of tape. You can often see this in skew, the premium paid for downside protection versus upside exposure. When skew steepens at the same time implied volatility rises, it suggests buyers are paying for insurance, not chasing excitement. Now connect that to institutional behavior that rarely makes headlines. Large asset managers maintain target risk. Risk parity portfolios adjust when realized volatility rises. CTAs and trend systems reduce exposure when momentum flips. Banks manage inventory and balance sheet limits. None of that requires a narrative. It requires thresholds. Cross them and the machine moves. That's why 2022 in the UK gilt market matters as a reference point. Liability-driven strategies were stressed because rates move fast enough to trigger margin calls and collateral demands. The response required forced selling, and the lesson was simple. Leverage plus volatility plus collateral constraints equals speed. So when you see metals slammed and equities wobble while volatility surges, consider the possibility that multiple machines are moving at once. One machine is options hedging, another is margin and collateral, another is systematic de-risking. Each machine is rational on its own. Together, they can create an air pocket. When dealers flip from damping moves to chasing them, the market can travel farther, faster than fundamentals justify in the moment. Here is a way to visualize it without jargon. Picture a car with 3 braking systems. The driver taps the brake. That's discretionary selling. The second system is automatic braking that triggers when distance closes. That's dealer hedging and risk limits. The third system is the emergency brake that locks when the car starts sliding. That's margin and collateral. Most days, you never notice the other 2 systems. In a fragile regime, they can all engage at once. That's why the tape can disagree with the headline. The headline reports what happened to the index. The tape reports what happened to the system. And the system is built, right now, on short-dated leverage and short-dated hedging. If this regime continues, the most important risk is not the next big story. It's the next small catalyst landing at the wrong moment. That's when a routine data point becomes a volatility event because the structure turns it into one. So the indicators matter. Watch the relationship between realized and implied volatility. When implied stays elevated despite contained realized moves, it signals persistent demand for insurance. Watch how quickly volatility fades after sell-offs. In stable regimes, it fades fast. In fragile regimes, it sticks. Watch liquidity around the open and close because hedging and rebalancing concentrate there. And watch whether markets that usually offset each other stop doing it. None of this tells you what to do. It tells you what the tape is saying. It tells you that volatility might be the symptom, not the cause. Now we get to the human part, the choice ahead. There are 2 ways people experience markets like this. One group sees the label. They assume it means randomness. They assume no one knows anything. They stop paying attention, or they overreact to every red candle. The other group watches the structure. They ask, who is forced to do what, at what price, under what rule? They treat the market like a system of constraints, not a morality play. Not a popularity contest, a system. And the uncomfortable truth is that institutions usually move first because their risk systems demand it. Retail usually moves last because narratives arrive after the flows. That's not about intelligence. It's about information and timing. The information gap becomes a wealth gap when the market is being driven by mechanics, not because anyone is smarter, because some participants are closer to the plumbing. So when you hear they're calling it volatility, remember that it might just be the headline-friendly way of saying the market structure is doing something unusual. The tape is pricing protection faster than the index is moving. The options complex is louder than the cash market. Margin and collateral are shifting the ground under leverage. And cross-market behavior is refusing to unify into a single story. If this connected dots you hadn't seen, keep listening. This is Channel Name, where we decode what matters before its headlines. The question isn't whether the market will have another volatile day. Markets always do. The question is whether you're watching the label or watching the tape that explains why the label appeared in the first place.